The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program,
Okay, so looking at the Fed projections, it looks like they're saying change in real GDP March 7, versus 6.5. That's up 0.5%. Unemployment rate unchanged. Disagree with that. PC inflation March projection 3.4 versus 2.4. I'm probably okay with that. Federal funds rate March projection 0.1. Yeah, they're going to leave it the same. 2022 leave it the same, and 0.6% in 2023. What that really means is they're expecting the inflation to increase quite a bit. They're not going to be able to hide it forever. Unemployment 4.5. Again, I disagree with that. I think it's going to be higher. I think it is higher. Core PC inflation, I think it's a lot higher than that. All you have to do is look at your gasoline, your fuel prices, and really your grocery bill that's gone up 25%. Chicken shortages, meat shortages, the drought, worst one in recorded history going on right now. Utah declaring a national emergency for drought. All right, change in real GDP. Look at that. Crazy. Crazy. Longer term stuff. All right. PC inflation. All right, let's see what kind of effect that's having. Yep, that's what we thought. All right, you've got the Dow down 275, NASDAQ down 97. You've got the S&P down 31, and you've got a jump in the VIX up 7% increase in the VIX up to 18.26. So down we go. Everything's down. Crypto's down. Everything's down. If there's anything going up, let's see on the stock side. Yep, you've got the 30-year yield up to 2.199 and the 10-year yield up to 1.526. Oil 74.20 on the Brent crude, down just a little bit. Light crude 71.99. That was at 72 earlier this morning. AMC down. Everything is basically down. Tesla's up a little bit, $600. Ford up above $15 again. Palantir 24.45. Amazon up a little bit, probably in anticipation of Prime Day coming up. GM down, or Cinemac up, GM up. Beyond Meat's up. Workhorse up. Shoals up. Palladium up a little bit. Silver down a little bit. Gold down a little bit. Platinum down a little bit. Hey, I should have another one up here. Hold on a second. Return default. Let's look at the SPY. That is an Ethereum signal on the buy side. So market going up. People looks like they want to flee a little bit towards the Bitcoin. Be careful on the SPY here, folks. The real move is going to come when the news conference happens, which is going to be in 23 minutes. We'll carry that live. I already have it ready to go here. Apparently, I still had it up. Let's cover that. There we go. Apologies for that. All right, so here's our SPY. Here's our Dow. Dow down 203. Big time jump down. Definitely operating on a buy side. I probably would not have bought there in anticipation of the Fed release at 11 o'clock Pacific, 2 o'clock Eastern time. Again, we just covered that. See what else we got in here. Charts, and more charts. Change in real GDP. Weighted. Actual. Median projection, confidence level, confidence interval based on historical forecast errors. On unemployment rate, again, huge spike obviously last year. And you have so many people that are out of the economy completely. And they're not even participating and they're not counted on those numbers as well. How many people do you know that aren't working? All right, change in real GDP. Again, forecast 2020, 2021. It's just ridiculous, dude. God, the fact that they release this stuff and it's not even true. It is not even true. You look at this stuff and you say, Fed leaves key interest rates unchanged, but raises inflation expectations. Let's see if I get paywalled here before I scroll. Nope. Welcome to the latest decision day. I'm approaching my article limit. See, I try and save these. Fed believes the recent surge in inflation is just transitory. Disagree. It's here for a while, folks. It is here for a while. High lumber price, other barriers choke the confidence of home builders and home buyers. We knew that already. And that seems, let's see here. Let's see how loud that is. Fed believes the recent surge in inflation is just... Okay. All right, so what does that mean? Well, what that means is it's basically portending about the issue of inflation. So now we're getting a little bit of the bounce. Let's see what the VIX did. VIX probably popped down a little bit. So the VIX is down a little bit, 17.68. You can see where it was from this morning, from the market open right about here. Trailed down to 1642. That's going to be another sell indicator on Ethereum. Get up here. There's a BTC. All right, so Dow down now 205, NASDAQ down 73, S&P down 24. So SPY's down 0.62%. A little bit of a bounce here. We're on a 3-minute. Let's go to a 30-second chart. NASDAQ. So here's your S&P 500. Volatility came right back down though. So volatility on the initial bump on the news release right at 11 o'clock Pacific, 2 Eastern. Then it ran up a little bit, and now people are getting into the numbers. This is basically a carbon copy of what he said of what he said before, and they're trying to hide this stuff. And you can't hide the fact on the dollar. You cannot hide this. You can't hide this stuff here as it's going back up. 10-year yield, 30-year yield. Look at this. This is from tracking all the way back to April of 2020. This is a weekly chart you're looking at. So on a weekly chart, if you're looking at the all you gotta do is say, look at this stuff, and take a look at that, and take a look at this, and know that basically rates are increasing. So you got your 30-year rate definitely going up. You got your 10-year rate doing the same. Okay. Again, you got the same thing here, increasing, right? Going up. Crazy. Crazy. And the 10-year is more of a barometer than anything else. And get rid of those. You keep that one there. And you look at this and you say, as a percentage, what has it gone up to? Well, if you just take if you forget about the wicks and just take this bottom on this candle right here, and then take it up to where we're at right now, and that is a 186% increase in the U.S. 10-year Treasury since August of last year through today. So that's what you're looking at in terms of the 10-year. And when you see that, you can't discount it. You can't discount that. Oops, Control Z. You can't discount that. That's gonna be there. And then you go into the play and you say, well, what's oil done since then? I called oil above $70 months and months and months ago when it was down here in this range and I was trading it actively. And people said I was nuts. They said I was nuts. It's never going to go to $70 a barrel. It ain't going to happen. And now we have light crude, Texas light crude, $71.96, almost $72. UK oil is $74. And then you got companies like ExxonMobil sitting at $64 a share. Crazy growth, man. Look at that. You got ExxonMobil all the way up from there to there. 101% rate of return since October on Exxon. And I've been screaming about oil and inflation even before that, but seeing that this stuff was kind of coming. So what does that mean going forward? Well, what that means going forward is this guy can't keep going. There's got to be some pressure on these things. These things have got to start moving back down towards an average, towards a mean. Because when you have inflation, when you have oil doing this, and you have the S&P doing this, and you have the NASDAQ doing that, at some point it's got to come back to some averages. Now, when I did this due diligence, on the NASDAQ back on 25th of April. I'm sorry, 25th of March. So 25th of March is when I looked at this. It's when I drew my Fibonacci. It's when I did the vertical line here. And then I left it through the 3rd of May. And I didn't extend it out further because I wanted to see what happened. Because I'll go back and I'll take a look and say, hey, where are we at? Well, if you look at this top resistance level of when I drew it here at the top of the fib, look what happened. Hit it there, hit it there. We've got a pivot of 12,462. So I'm going to set an alert for 12,467. 12,450. Let's call it 12,460. 461. 12,461. And I want to see if it comes back down to that pivot point, which it should. And if it does, then it should retest this area down here of the 12,024. So when you're talking about inflation coming in, and you're talking about the Fed, and you're looking at what they are doing. Where is my? Oh, sorry, there it is. And let's go back up to the summary, up to the top. That's the numbers. Let's go to the press release. I don't want to do that. That's fine. Here's a statement. Let's go back to the numbers. PDF, we'll leave that up. Here's a statement. All right, committed to using its full range of tools, which means they're going to keep buying mortgage-backed securities, right? That's what they're going to keep doing. And if you guys got a question about any of this, feel free to post it in the chat, and I'll answer it to the best of my ability here. Progress on vaccinations has reduced the spread of COVID-19. I'm hearing rumblings of now, instead of a COVID lockdown, get ready for this, folks. You heard it here first. Climate lockdowns. The WHO. I'll cover that in a second. Watch this. We'll cover that in a minute. All right. Committee seeks to achieve maximum employment inflation at the rate of 2% over the longer run. With inflation having run persistently below this longer run goal, the committee will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. My confidence in their ability to do that when rates are basically at zero, I don't think they're going to be able to do it. The committee decided to keep the target rate for the federal funds rate at 0 to 0.25%. Okay, so they're going to have to, even Yellen slipped last month when she was talking about an increase in inflation being a cause for the Fed to look at rate increases even this year. And then she got her hand slapped because she's not in charge of the Fed anymore. She's only Secretary of Treasury. She came back. She retracted basically that statement, clarified it to go in line with what Jay Powell said. So Pew Pew Powell is basically running the show. And let's face it, he's done a fantastic job under the prior administration, President Trump, and under President Biden. Thank goodness he's still in there. I still think he's done. I still think he's done. He's not going to get reappointed again or renominated again, and he's going to retire, and they'll turn it over to someone else. My worry is that the person that they turn it over to won't have the patience of someone like Jerome Powell. That'll be more of a loose cannon, more like Janet Yellen. and those political idiocies aside, that's where the trouble comes in. And so when you look at inflation and you look at things like gas prices, and we're at 307 and California 423, most people in California are paying upwards of $5 a gallon for a gallon of gas right now, and that stuff's going to happen. Fear and greed index, we're at 45. We were at 51 yesterday. Now we're at 45. This is dipping down, and what that tells me is everything that I've been talking about is really starting to come into play. It took a little bit longer. I thought we would be at this stage a little bit sooner than what we actually are. And so the fact that you have this, again, this is a daily chart of the NASDAQ composite. Look at the NASDAQ composite. Now what I want you to look at is I want you to look at the 10-year over a daily. Now look at the 30-year interest rates over the daily. Now look at the 20-year coming down. Look at this. You have this diversion and separation of the 20-year versus the 10-year and the 30-year, and you have this reversal going on, and all this is happening. You cannot have this continue. It cannot continue. Not when increases in gasoline, not when increase in food prices. You have a shortage. There's still going to be gas shortages this summer. Mark my words, in July, next month, you're going to see some issues. And along with that, you also have oil, $72 a barrel basically on the light crude. The Brent crude is at $74. This cannot sustain. My recommendation, just be careful. Hedge some stuff. If you got stock and you're worried about it going down lower than what it's at right now, maybe take a look at it. You know, there was big news this morning on Boeing. I've been talking about Boeing for, actually for years if you knew me personally. But looking at what's going on with 3-minute chart, you know, they're down $4.14 with a settlement with the EU on tariffs. That they're going to wash their hands, release the tariffs that have been going on as a battle for 17 years. And what they've agreed to do is now take those things and apply them against China. Well, basically, Airbus won the war. Airbus won the war. With the 737 MAX issues and all the issues with that, the 787, the plant closing down in Everett, the one in South Carolina being the chosen child for the 787, and then some manufacturing issues out of it at Everett 787s because they were losing their jobs. Don't get me going on that one. So, but you know, Boeing pulling back on that because they didn't get anything out of it. They lost. The tariffs are removed. The French wine, the French cheese, the Scotch whiskey, all those go away. And then the airplane subsidies or the airplane tariffs on Boeing also go away along with the Airbus ones. And so what you should be seeing is if we get some sort of recovery, I'm going to look to start pumping money back into Boeing. I don't think it's done yet. I think there's still another chance that when the market does this, Boeing is going to do that as well. And I had old due diligence from last year. I'm going to do it again. And I'm going to set an alert on Boeing at 188. I'll go a little bit higher. 191. So if it's coming up to it, we'll go 192. $193. And I'm going to set that alert on that. And do I think it can come back down to there? Yeah, actually I do. I think there's going to be another run on Boeing. So just be careful with all your stuff. You got all this stuff going in. Inflation is here. All you have to do is look. If you're not doing this already, take your groceries receipts and start saving them. And save like one a month for the next 3-4 months. And then compare the same stuff you buy each trip to the grocery store or every third trip to the grocery store or whatever the case is. Look at the prices. I know stuff that I've been using Amazon delivery since when the thing started happening last year. And I know that my costs have gone up. Something that cost me $65 now is running $90. Excuse me, all day long. Gas prices, oil prices, all that filters down. There's a lag between this increase in oil and the distribution and delivery system. There's still such a shortage of containers on both coasts because of the backlog of production issues from really Southeast Asia, China, etc. And so we're going to carry the Powell News Conference, and we'll have that on the channel here. And that's going to have that's going to have an opportunity to see what they're going to say. And again, the statement's going to be the blanket statement that they already released that we went over. What's going to be important is what he says on the questions and who they call on and what those folks say. So that's going to be the difference there. And then we're going to see what's going to happen. So initially, let's go to a 3-minute chart and let's look at this. Look at the S&P. So that's why we got further downside happening, and it's going to continue. It's probably going to get worse. It's probably going to get worse before the market closes at 1 o'clock too. So I don't think that he's going to be able to say anything that's going to boost this market. If anything, he may say some things that are going to spook it even more. So that could be issues. Okay. And let me get this one back over here. Oops. Hey, get back up there. Come here. I do want to look at... Drag this one over here. And hit it up. Why is that? Well, that doesn't look right, does it? There we go. Yeah, is this one on auto? Yeah, that one's on auto. Okay, so we have Bitcoin on the left, Ethereum on the right. Again, you've got some, let me close this. Let's see, 2 o'clock in the morning here. Okay, and get these looking similar. And again, when you have a downslide in the market, when you have this kind of stuff happening, right, these two are going to follow each other. But what's not going to happen is when the market starts recovering, Ethereum is going to continue to outperform. So Bitcoin over the last 3 months is still down 38%. If you look at Ethereum over the last 3 months, it is down 1.46%. So those are numbers that when you look at this, that's something that you want to be concerned of. So when these start to bounce and recover, Ethereum should continue to outperform. You also have VIP 1559. That's coming up soon, and so that's going to be interesting as well. All right, so what I'm going to do here is, well, let's get rid of this. And now we have the S&P, we have the NASDAQ composite on the top, S&P 500 in the middle, and the VIX on the bottom, okay? And now we're going to get this ready to go, okay? Why is this so lumpy looking? Okay. All right, so that's ready to go. And we can watch, we'll watch that. I don't know why that, oh, yeah, I know why. Sorry. Okay. And we don't need a big Powell. We just need to be able to hear him, right? So actually, you know what? I think I'll leave these over here. And we're going to key in on the S&P 500. So you'll have the live pricing there. And then I'm not going to click on it as we listen to him speak. Okay, so they've got that window locked into a size, which is fine. I'm not going to do a full screen. Because we want to be able to see and hear what he's doing and what he's saying. So you guys think he's going to say anything else that's going to tank this thing? I think he will. I think that he's going to get some sort of question, and that question that he's going to get, he's going to have to admit about inflation. And if somebody mentions oil prices, if somebody mentions pipelines being closed down, or things of that nature, and you have to ask yourself, what would be the major catalyst, right? And the major catalyst is, we're in a drought. Most of the country in the western states are in a serious drought, one of the worst ones ever. and it's like a 22-year drought now. And all you have to do is look at the levels of like Lake Powell to see that. All right, so I'm going to pause this. Here's your heat map. That, and we'll turn that up just a little bit so you guys can hear them a little bit better. And we should have them on right now. Where's he at? Here we go.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance about interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete, and risks to the economic outlook remain. As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment rate remained elevated in May at 5.8%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year and declining to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term. These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, inflation is expected to drop back toward our longer run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy. The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. The committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Mr. Chair. First, we'll go to Rachel Siegel, The Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can walk us through expectations you have specifically when it comes to the labor market going into 2023. And I'm curious about people who may have left the labor market, who have yet to come back, or who may face issues with childcare, perhaps they've retired early, any barriers that you see keeping people from the labor market as you consider full employment going into 2023. Thank you.
Thank you. So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market, a labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame and think 1 and 2 years out, we're going to be looking at a very, very strong labor market. In terms of exactly what that means, we'll have to see how things evolve. I think we learned during the course of the last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation will be as we go forward, but I would tend to look at it and think that it can return to high levels, although it may take some time to do that. But overall, this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a couple of things, a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people who are unemployed, and the pace of filling those jobs somehow feels slower than it might be. So I'd point to a number of things. The first of which is just that most of the act of sort of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match what the employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that we look at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly holding back some people, and that should diminish as vaccinations move ahead. There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, or not in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this. And so I think we have to be humble about our ability to understand the data. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient. And I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
Thank you. Paul Kiernan.
Hi, Chairman Powell. Thanks for the question. The committee's medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you get nervous. Thanks.
So inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So, for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up, and at some point they in some cases should actually go down. And we did see that in the case of lumber. Another example where we haven't seen that yet is prices for used cars, which accounted for more than a third of the total increase in core inflation. Used car prices are going up because of sort of a perfect storm of very strong demand and limited supply. It's going up at just an amazing annual rate. But we do think that it makes sense that that would stop and that, in fact, it would reverse over time. So we think we'll be seeing some of that. When will we be seeing it? We're not sure. That narrative still seems quite likely to prove correct, though, although, you know, as I pointed out at the last press conference, the timing of that is pretty uncertain, and so are the effects in the near term. But over time, it seems likely that these very specific things that are driving up inflation will be temporary, and we'll be on. You know, we're going to be looking. We'll be looking at the monthly pricing data. I'll also say that the labor market is going to be important both for the maximum employment goal, but also for inflation. And we'll be looking at that. And as I mentioned, we expect, and I expect, that we'll see increases in supply over coming months as the factors that we believe have been suppressing supply abate, wane, move down. So I can't give you an exact number or an exact time, but I would say that we do expect inflation to move down. If you look at the forecasts for 2021 and 2022 and 2023 among my colleagues on the Federal Open Market Committee, you'll see that people do expect inflation to move down meaningfully toward our goal. And I think the full range of inflation projections for 2023, it falls between 2 and 2.3%, which is consistent with our goals.
Thanks.
Thank you. Now we'll go to Ilan Mui at CNBC.
Hi, thank you, Chair Powell, for doing this. My question for you is that you mentioned that your colleagues did have a discussion about the progress that you're making toward your goals in order to consider tapering your asset purchases. In that discussion, you said that you haven't made substantial progress yet, but that you expect to continue to make progress. In that discussion, did you guys talk about a timeline for when you expect to see that progress be made and when you might consider starting to reduce those purchases?
Right. So I expect that we'll be able to say more about timing as we see more data, basically. There's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So at coming meetings, the committee will continue to assess the economy's progress toward our goals and will give advance notice before announcing any decision. The timing, of course, Ilan, will depend on the pace of that progress and not on any calendar.
Thank you. Now we'll go to Chris Rugaber, AP.
Right, thank you. Well, you mentioned, let me ask about inflation expectations. You said they were, I think you mentioned in your opening statement that you saw them as within target. Does that mean that some of the shorter term measures we've seen out there, such as the New York Federal Reserve's 3-year outlook, which jumped a bit, should those sort of be dismissed? And are we only looking at longer term inflation expectations? And would you describe those as still well anchored at this point? And on a related note, would the Fed consider publishing its index of common inflation expectations on a monthly basis? Thank you.
So we do tend to look at the longer term inflation expectations because that's really, we think, what matters for inflation. The shorter term ones do tend to move around based on, for example, gasoline prices. So you'll see if gasoline prices were to spike, you'll see the shorter term inflation expectation measures, particularly the surveys, move up. And that's maybe not a good signal for future inflation if gas happens to spike and then go back down again. Yes, I think if you look at the broad range of longer term inflation expectations, they've moved up. They moved down at the beginning of the pandemic, sort of further exacerbating concerns that we might find ourselves where, for example, the ECB and the Bank of Japan have been, where you have expectations and inflation itself sliding down, and you have a really hard time stopping that process once it begins. So that was a concern. So it's good actually to see longer-term inflation expectations move back up to a range. It's a range that's consistent with what our objectives are. These are not precise measures, and they contain risk premiums of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's a wide index, as I'm sure you know. We look at that and we see them back in the range where they were, and by the way, they've been broadly higher than that, somewhat modestly higher than that, not so many years ago, at a time when inflation was still anchored and at around 2% or maybe even a little bit below. So the answer is yes, I think they are anchored and they're at a good place right now. It's gratifying to see them having moved up off of their pandemic lows. And as you know, it's fundamental in our framework, our new framework, to assure that longer-term inflation expectations are anchored at a place that is consistent with our goal. We think that's an important reason. If inflation expectations are not anchored at a place that's consistent with your goal, it's not clear why you would expect to hit your goal over the longer term. So it's important.
Okay, now we'll go to James Politi with the FT.
Chair Powell. Hi, thanks, Chair Powell. Your economic projections today forecast 7% growth in 2022, unemployment for 4.5%, and core inflation of 3%. If those conditions are achieved by the end of the year, would that constitute substantial further progress in your mind? And kind of more broadly, when you look at the sort of median forecast for interest rates in 2023 showing not one, but 2 interest rate increases at the time, is this kind of, can you describe the sort of tone of the discussion in the committee, and are we really moving towards sort of a post-pandemic stance? Is there greater confidence that the recovery will be a full recovery sooner than expected?
On your first question, the judgment of when we have arrived at substantial further progress is one that the committee will make, and it would not be appropriate for me to lay out particular numbers that do or do not qualify. That is the process that we're beginning now. At the next meeting, we will begin meeting by meeting to assess that progress and talk about what we think we're seeing, and just do all of the things that you do to sort of clarify your thinking around the process of deciding whether and how to adjust the pace and composition of asset purchases. In terms of the 2 hikes, so let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. If you look at the transcripts from 5 years ago, you'll see that sometimes people mention their rate path in their interventions. Often they don't. And the last thing to say is the dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots. So dots to be taken with a big grain of salt. However, so let me talk about this meeting. The committee spelled out, as you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%. And the projections, they give some sense of how participants see the economy evolving in their most likely case. And honestly, the main message I would take away from the SEP is that participants, many participants, are more comfortable that the economic conditions in the committee's forward guidance will be met somewhat sooner than previously anticipated. And that would be a welcome development. If such outcomes materialize, it means the economy will have made faster progress toward our goals. So the other thing I'll say is rate increases are really not at all the focus of the committee. The focus of the committee is the current state of the economy, but in terms of our tools, it's about asset purchases. That's what we're thinking about. Liftoff is well into the future. The conditions for liftoff were very far from maximum employment, for example. It's a consideration for the future. So the near-term thing is really, the real near-term discussion that will begin is really about the path of asset purchases. And as I mentioned, we had a discussion about that today and expect to, at future meetings, continue to think about our progress.
Thank you. We'll go to Nancy Marshall-Genzer from Marketplace.
Chair Powell, continuing in that vein, when you're ready, how will you go about signaling the start of tapering when you do decide to do that?
So our intention for this process is that it will be orderly, methodical, and transparent. And I can just tell you, we see real value in communicating well in advance what our thinking is, and we'll try to be clear. And as I mentioned, we'll give advance notice before announcing a decision to taper. And so all I can say is that we think it's important. We think where the balance sheet's concerned, a lot of notice, as much transparency as we can give, and as far in advance as we can, to give people a chance to adjust their expectations. And we expect to be in that business until we reach substantial further progress, and then have a decision. Again, I have nothing further on time. It wouldn't be appropriate to say we're going to have to see more data. We're a ways away from substantial further progress, we think, but we're making progress.
So you can't say generally how far in advance you would signal.
Again, as we approach that goal, we'll provide as much clarity as we can.
Great, thank you. Going to Craig Torres at Bloomberg.
Craig Torres at Bloomberg. If I were a businessman looking at the forecast today, I would ask how and when the Fed seeks to achieve an average of 2% inflation. In other words, does the FOMC have a look-back period, or does it plan to suppress inflation in outer years? Because over the next 3 years, you're going to be above inflation. So what is your look-back period? Does the committee have one? And if not, why not? And if they don't, why isn't this just flexible inflation targeting without an average in a range of 2 to 2.25%? Thanks.
So as part of our year-and-a-half long process, the review that we did and came out with at the end of that with the new statement on longer run goals and monetary policy strategy, we looked carefully at the idea. We've all read all of the literature around different formulas for makeup and things like that. And we concluded, and I strongly agree that it's not wise to wed yourself to a particular formulation of that. So we did adopt a discretionary. There's an element of discretion in it. It says that we will seek inflation that runs moderately above 2% for some time, and it's meant to create a broad sense that we want inflation to average 2% over time, and that under the old formula, under the old framework, what was happening was 2% was a ceiling. Because all of the errors were below, you were always getting back to 2%, so you were bouncing back and forth between 1.5 and 2, and we wanted them to be centered around 2. So that's the approach that we're taking. You're right, it's not a formula-like approach. We were clear on that when we announced the framework. Was there another part of your question, Craig?
That pretty much answers it, Chair Powell. Thank you.
Thank you. Now we'll go to Michael Derby.
Thanks for taking my question. So I wanted to ask you about the reverse repo usage that we've seen lately. I was curious if you are at all concerned about the level of money flowing into the reverse repo facility, and do you believe that the changes in the Fed's rate control toolkit today will have any impact on that? And then in a related question, do you think that Fed asset purchases are taking too many safe assets out of the market right now and creating maybe some dislocations in the money markets?
So on the facility, we think it's doing its job. We think it's doing the reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within its range. So we're not concerned with it. It's doing. You have an unusual situation where the Treasury General account is shrinking and bill supply is shrinking, and so there's downward pressure. We're buying assets. There's downward pressure on short-term rates, and that facility is doing what we think it's supposed to do. Sorry, your second question was again?
Yeah, I mean, the change in the rate control toolkit, will that have any impact on, do you think that will reduce the amount of money coming into reverse repos? Will that have any impact on money market conditions that, beyond the Fed funds rate setting?
It could have some impact. I think we'll have to see empirically, but it's designed to keep the federal funds rate within the range, and I do think it could have some effect on broader money market conditions below, as it relates to the very low rates and the downward pressures.
Okay. And do you think it will lower uptake on the reverse repo facility, or that's just not even really a focus of what the change was?
It's not. It's honestly, and the funny thing is, you would think that it would, but we'll have to see. It's possible that would not be the case. Well, that's going to be an empirical question.
Okay, cool. Thank you.
I will go to Gina Smialek, the New York Times.
Hey, Chair Powell. Thank you for taking our questions. I was wondering if you could follow up a little bit on your response to Rachel at the very beginning and talk a little bit about how we should understand what full employment means in a world that, as you mentioned, is pretty roiled. All the data has been pretty roiled by the pandemic, and we're not really sure where EPOP is going to settle in. We're not sure where participation is going to settle in, and wages are already looking decent. So I guess I wonder what full employment means in this context and sort of how you're thinking about those wage data.
Yeah, as you well know, there isn't one indicator we can look to, and there's no one number that we can therefore point to. We look at a range of indicators, and it's a very broad range. You can count to a high number just quickly, but certainly it will include things like unemployment and participation and wages and many different flavors of that. So how do we think about it? A couple things. We're all going to be informed by what we saw in the last cycle, which was labor supply outperforming expectations over a long period of time. Now, that hadn't happened in many other cycles, but this was a very long cycle. So we're going to have to be alert to see whether that can happen again. It's a different economy. We have had a slew of retirements, and that may weigh on participation. That effect, though, should wear off in a few years, and as you move through that window. because people would have retired anyway, and you'll be back where you would have been. So I think I think the lesson number one is just to be careful about assessing maximum employment. And I think during the last cycle, there were waves of concern that we were reaching full employment as early, as 2012 when I arrived at the Fed. And 8 years later, we were still creating jobs, and it was quite remarkable. So we're all going to be informed by that. At the same time, we understand this is a different economy. The demographics people are getting older, and that should have a secular effect of reducing participation over time. So we have to be sensible about what can be done. But I think we're going to lean into that and be optimistic. You asked about wages. We're seeing wage increases. That's sort of a natural thing to be seeing in a strong economy. And what we're seeing is that we don't see anything that's troubling in the sense of what would be troubling would be, very wide across the economy, wages at unsustainable levels without high inflation. In other words, wages in excess of productivity and inflation by a meaningful amount broadly across the economy, sort of forcing companies to keep raising prices and getting into a wage price cycle. That's the old formula one of the old formulas for having high inflation. We don't see anything like that now. We do see high wages. We see them for people who are mostly new, entering into new jobs, many of them in low-skilled jobs. And but we do think you've got a thing in the labor market right now where supply and demand are just not matched up well. And we think it's a flexible economy, and it will clear. There will be a level at which supply and demand meet, and we think that'll be happening in coming months. So, but the last thing I'll say is, again, if you look at the forecasts, we're going to be in a very strong labor market pretty quickly here. There's still a big group of unemployed people, and we're not going to forget about them. We're going to do everything we can to get people back into work and give them the chance to work. But there's every reason to think that we'll be in a labor market with very attractive numbers, with low unemployment, high participation, and rising wages across the spectrum. So that's a little bit how we're looking at the labor market.
Thank you. Now we'll go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the status of your thinking around the supplementary leverage ratio right now. Is the Fed still thinking about ways to permanently adjust this to account for the high growth in deposits? And do you ultimately believe a permanent fix is needed? And any information on the timing around that would be helpful.
I can say is we're working on it. Don't have anything to share with you in terms of the particulars or the timing right now, unfortunately, but we've always, our position has been for a long time, and it is now, that we like the leverage ratio to be a backstop to risk-based capital requirements. When leverage requirements are binding, it does skew incentives for firms to substitute low-risk assets for high-risk ones. It's a straightforward thing. And because of the substantial increase in reserves, treasuries, and other safe assets in the banking system, the SLR is rapidly ceasing to be the intended backstop for our big firms that we want it to be. So we do think it's appropriate to consider ways to adapt it to this new high reserves environment, and we're looking hard at the issue. We would also, just to be really clear, we will take whatever actions are necessary to assure that any changes we do make or recommend do not erode the overall strength of bank capital requirements. So sorry, I can't give you any more. That's just something we're working on.
Thank you. Now we'll go to Anakin Tappa at CNN Business.
Hi there. Thanks for taking my question. Chairman Powell, the price jumps we've seen in some raw materials, lumber, for example, you mentioned it earlier, seem to be easing, and it looks like we're in the beginning of suppliers catching up with demand. But I wonder if you're worried at all if we're going to end up with excess supply immediately after those shortages wear off, and if we just continue this mismatch as we're recovering and getting out of the pandemic economy. And I wonder how that would affect the Fed's outlook at all.
Well, that is really not the problem we're having right now. And actually, people who work in commodity industries are very focused on that because they know that they don't want to build capacity and then find out that it's not necessary. So really, the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there. But in terms of overcorrecting, I mean, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. But that's not really where our focus is right now. Our focus right now is we need to. Our expectation is that these high inflation readings that we're seeing now will start to abate, and that's what we think, and it'll be like the lumber experience and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors in the most recent CPI report that went up a lot. We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot. Because if they are, people will build new hotels. There's no reason for supply and demand to be out of whack in the hotel business over any period of time. So we think that'll happen. I think in terms of the timing and the effects on inflation in the near term, there's a lot of uncertainty. The overall story is one that we think is right, and we think the incoming data support it. And so do many forecasters. And if you look at the forecasts on the FOMC, you will see that as well. But we don't in any way dismiss the chance that it can work out that this goes on longer than expected, and the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really materially above what we would see as consistent with our goals, and persistently so, we wouldn't hesitate to use our tools to address that. That's it. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But there's a lot to be humble about among forecasters. Forecasters have a lot to be humble about. It's a highly uncertain business, and we're very much attuned to the risks and watching the data carefully. In the meantime, I would say, we should, as I mentioned earlier, there's so much uncertainty around this. It's just a unique situation that we need to see how things evolve in coming months and see how that story holds up and act accordingly.
Thank you. We'll go to Howard Schneider at Reuters.
Howard Schneider, Reuters. Thanks, Chair Powell, for taking this. I don't want to miss the moment here, and I noticed that in the statement you dropped the language saying that the pandemic is weighing on the economy. So is this the effective end, in your view, of the pandemic as a constraint on economic activity, even though it's still cited as a risk?
It's a continuum, right? What you've seen with the pandemic is sharply declining cases, hospitalizations, and deaths, and that's great. And that should continue. But you also saw in the United Kingdom, which has, I think, at least as high, if not higher, vaccination rates. They've had an outbreak of the Delta variety, and it's causing them to have to react to that. So you're not out of the woods at this point, and it would be premature in my thinking, it would be premature to declare victory. Vaccination has a ways to go to get to levels. It would be good to see it get to a substantially higher level, and that can only help. You're right. The statement language is evolving. I would expect it to continue to evolve. There's a lot of judgment in that, but you can expect us to drag our feet a little bit on that because that's what you do with statement language. It's great to see the progress, but again, I would not declare victory yet. I would say it is so great to see the reopening of the economy, though, and to see people out living their lives again. Who doesn't want to see that? And it appears to be safe, and I just would encourage people to continue to get vaccinated.
if I could follow up on that, if you view the statement in toto and the dots and the steps as well, do you think this is more a mark-to-market exercise around the improvement in health or around the inflation risks you see developing out there?
I think it's both. No, I think clearly since March, what's happened is people have grown more confident in these very strong outcomes that they'll be achieved. Very strong outcomes in the economy will be achieved. There's more grounds for confidence. We've seen growth come in higher than we expected. We've seen very strong labor demand. We've also seen we have seen inflation above target though, and I think even though in our forecasters' case, they do see inflation coming back down over 22 and 23 into areas that are very consistent with our mandate. Nonetheless, the risk is something that can factor into people's thinking about appropriate monetary policy. The thing is, these are 18 different forecasts, and I can't stand here and say exactly what was in all 18 people's minds, but that is something that I think can factor into things as well, factor into our forecasts as well.
Thank you.
Thank you. We'll go to Victoria Guida with Politico.
Hi, Chair Powell. I wanted to ask a little bit more about inflation to make sure I understand how you're thinking about this. So in the projections, inflation is expected to be high this year and then come back down next year, and then maybe start to rise a little bit again, enough for a liftoff in 2023. I know that's obviously, take that with a grain of salt, but that would suggest that you all could theoretically see inflation sustainably staying above 2%. And so I guess my question is, what would be causing that inflation? What would be, because it seems like you all now see a situation in which inflation would be rising in a way that isn't caused by transitory factors in the next couple of years. So would that be the result of a tight labor market? Would that be because this whole situation has raised people's inflation expectations? How are you thinking about that?
So what we're seeing in the near term, again, our base case is that what we're seeing in the near term is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, the supply and demand sides of the economy adapt. We have a very highly adaptive, flexible economy, more so than most. And by 2023. Those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is the way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy, and lifting up inflation. That's why you would see it then, because by then, in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change in the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's all in people's individual thinking, and you can't. It's hard to say. It's not something the committee debates in terms of what the outlook is for 2023. So I'm a little bit speculating, which I shouldn't do. But I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had, and thinking that I have more confidence that we could see inflation above 2%. That it may not be as hard to do that as we thought. And that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things.
Thank you. Now we'll go to Greg Robb at MarketWatch.
Hi, thank you for taking my question. Chair Powell, I'm just looking at the forecast, and one thing I just don't think it's been talked about all that much is how much you guys, the Fed thinks that the economy is going to slow next year. I mean, are we looking at a scenario of a slowing economy next year as with higher inflation? And what do you think about that?
We're looking at an economy that will not have the degree of fiscal support. The fiscal support in the forecasts is much less than it was this year. So, but you've still got a very strong growth, well above the longer run potential output of the economy. You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022 and 2 to 2.3 in 2023. So you're right. You're seeing. I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year, coming on the back of a 7% growth year. That's a really good year. That's a year with a lot of momentum. That'll that'll cause significant job creation, and it will. I mean, we would take 3.5%. We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
Doesn't it seem like there's a risk of like stagflation, where that you're going to go from 7% and down? That means the economy is really dropping in some way. We haven't seen that, right?
Well, the economy's not the economy is still growing, and growing at a very healthy rate. Our estimate, I mean, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question in a different way, is there a risk that inflation will be higher than we think? Yes. As I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
Thank you. Going to Brian Chung with Yahoo.
Powell, Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%. But there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combine with demographic changes that have already been in effect to suggest that that longer-term neutral rate or R-star might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long-run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount, and that would be a good thing from the standpoint of the economy, because it would give the Fed more room to cut rates. The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn, for example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore then that would tend to result in better outcomes for the economy over time. You can't estimate it with great precision, I think we would be alert to, I mean, studying R-star is a whole industry unto itself, and I think we would be alert to factors that might raise R-star, the neutral rate of interest. And we'd try to keep up with that, and I think we're all thinking about that and the possibility of that. There are a lot of stories right now that essentially could lead to higher productivity growth and higher R-star. We don't know which of those stories will come true, but I mean, I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great. Thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street. And I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements, but if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announce a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're strongly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we've written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was, will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is, how do you separate in inflation? How do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017. If you remember it, prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that, and that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, I mean, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
That's right. And look, I mean, we have to balance the two goals, maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that it has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole, an unusual hole actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're gonna watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
Thank you very much.
Okay. That does it for Pew Pew Powell. And second, let's get this going in here. So yeah, the summary. I'll put the summary link in the chat if you want to go read what he said. And a statement. And again, talking about inflation, right? Those of you that have been with me for a while, or even before I started streaming full time, know what I've been talking about in terms of inflation and talking about the Fed. You know, it's interesting because if you think about one of the main things that I picked up on that he said was that they have missed inflation expectation forecasts for months. And I'm paraphrasing, but he said for months. And it's the same thing I've been saying after every statement he's been making for months, is that they've been wrong about it, they've been wrong about it, they've been wrong about it. Inflation is greater than where it's at right now. And GDP is still going to be a worry. I don't think we're going to get, the growth that we get is mainly going to be due to inflation and the numbers just getting bigger. Used cars. If you bought a used car for $10,000 and now that used car is $16,000, again, he's right about that part. It's gonna forecast into inflation. But you have to remember what's been the driver. And in my opinion, what's been the main driver on all this inflation is something I've been talking about for months, and it's right here. And we'll go to a daily chart. And we're talking about oil, okay? The world runs on fossil fuels. It doesn't run on renewable energy, even though solar and wind power and thermal and geothermal and hydro is all, the cost of those are actually going down, which is good. Fossil fuel still drives the world's economy. And as that is going to continue and that is not going to change, the main driver of inflation has really been fossil fuels and oil, in my opinion. And because as oil prices have gone up from $35 a barrel back in November, the daily chart, to $71.97 today, that is a 103% increase in the cost of a barrel of oil. And there's usually a 3 to 6 month lag. And if you go 6 months from November, that was May last month. And that lag was delayed, in my opinion, because of COVID. So now what you're seeing You're seeing this GDP revision forecast going up. You're seeing the inflation forecast going up. What Janet Yellen said last month, and she got her hand slapped over rates increasing earlier, she basically said what Powell said today. And then he tried to even pull back on that as well. Yeah, we're going to be fine. No, we're not. We're going up to possibly, in my opinion, 5, 6, 7% inflation. And you're going to see that in things going forward like the dollar. You're going to see that in things such as interest rates. I just had some clown call me on my house during the call. Well, he didn't call me, he texted me. And I did a whole texting with him. Would you consider selling the home on terms? And basically, which means I still own the home, and but it's a contract for deed basically. And this guy's out there basically trying to steal money from people. Because in a rising interest rate environment, that's what happens. There's predators in the real estate market. And in my opinion, he's one of them. Hold on a second. I'm getting glare on my head from, I know I can do it. That'll stop it. There we go. I got a skylight above me, and the sun is coming right down onto the laptop. All right. So when you have the 10-year going up like it is, when you have the 30-year going up like it is, when you have Texas Light Crude going up like it is, when you have Brent UK oil going up like it is, and then you have the Fed saying, hey, everything's fine. Yeah, the inflation. How long did they say there is no inflation? There's no inflation. I'm screaming on a channel about gas prices going up every day, which we looked at. We looked at oil multiple times a day to see what it was doing. We looked at news on oil, the refinery stuff that went on in Texas in earlier this year. We looked at that. We looked at oil. We talked about a 25%. It's probably even greater now. 25 to 30% shortage of drivers that are certified to transport oil and fuel. Usually in 2019, it was a 10% shortage. Now they're upwards of 25 to 30% shortage of fuel delivery drivers. And as this economy expands and starts opening up again, and prices go up, and it's not just a gallon of gas, because guess what? That gallon of gas has to get there. And guess who has to pay for all the fuel trucks for the groceries, the distribution systems that bring the products from the point of manufacture or from the ports over to the distribution warehouses, to collection warehouses, from collection warehouses to your local stores. And all those fuel prices and expenses. If you remember when fuel where it was before, and the last time we were at $74 a barrel was when? 2018, July 2018. And during this whole time frame, even in 2014, all the way back in here, 2011, 2012, what did we have from companies? Anybody remember? We had fuel surcharges. And the companies I worked for, we implemented fuel surcharges onto our bills to account for the increase in fuel prices. And that is continuing to happen right now. And you look at things and you look at the gas price and you say, hey man, we're up above $3 a gallon nationally, $1.20 higher in California than it is nationally, than the national average. Even Illinois is above $3 now. Pennsylvania, $3.17, $3.19 for New York. Why are these in a lighter shade of pink? Why do they keep moving the bar for the bright red? Because they don't want the country to realize and the obvious, that inflation is here. It is not only here, it is growing, and it is growing, in my opinion, exponentially. And by exponentially, when you look at oil, and I remember setting the alert at $70. And I said, if it hits $70, we'd be above $4 a gallon for a gallon of gas. And we're well above that in a lot of areas of the country. And so that's going to continue to happen. All right, let's take a look at what's going on in the markets. We've got about 22 minutes. 22 minutes till the close. Dow Jones Industrial Average currently down 210. The NASDAQ currently down 14. Nice recovery though. S&P actually down 15. It was up 7 right towards the end of the speech. Then a little bit of a dip there. SPY came up nicely. If you pick the bottom either here or if you held it and maybe you got it here, even if you got it here, take the middle of the 3, right, and you got it here, you know, nice play. If you sold anywhere in this range here on the pullback, you know, 0.75%, you know, on 50,000, yeah, that's $3,700. All right. Where am I going here? VIX shot back up again above 17. It did get all the way up to 19. So it did get up to 19, and then it dipped all the way to 16.84. That dip, that is going to be an Ethereum alert. Back to a 3-minute, and that's going to be on the what was that SPY alert? Nope, not on the SPY. I can look at the trigger. Yeah, buy alert. That's a buy alert on Ethereum. AMC hit 55.52, like we talked about. That's where I set the alert level, where I thought it was gonna, you know, I set that 55.52, and it hit that and then dipped a little bit further. So now we're going to see is what's AMC going to do. Let me get rid of this alert. I don't need that one open anymore. Dot started trading today. Hello. And we should see here we go. Yep. All right, so Dot is now trading on Coinbase and Coinbase Pro. And it looks like it started trading at 9 o'clock this morning Pacific time, so noon Eastern time. And again, I think what I'm going to do is I'm going to add Dot Binance on here. And we'll go Dot we'll go Dot Tether for Binance. There we go. And Binance. Okay, there we go. That way, if we start looking at this one and we go out to a 1 hour chart, we can see what it's doing on Binance, and then we can go over here to Coinbase because it just started trading today. You can move assets as of last weekend. You can move Polkadot into your Coinbase account. But for technical analysis and charts, etc., I want to take the longer look. So I'm going to leave it up here. And again, all my crypto ones, anything on green is delineated by it being traded on Coinbase, Coinbase Pro. Anything in yellow or orange here is delineated, as I have at the bottom, trading over on Binance. So some of the charts will be a little bit different. For example, you'll see a difference in the spread. You got 23, 29, and then you have 23.31. So you got about a penny difference there, 2 cents difference in the spreads between Binance and Coinbase. So you have that going on. All right, so Dow currently down 222, NASDAQ down 4. Get rid of that. Should be able to just clear. There we go. S&P down 15. So here's a dump, right, this morning, all day long, knowing that this inflation talk is going to come to bear. And then it came, and we bounced off of it, and it's as if the Fed meeting never happened. Look at that. Straight freaking line across here. It's as if the Fed meeting never even occurred. So, take that with you what you will. Oil, 19 cents. Let's check the heat map. As far as sectors go, We can get rid of gas prices. We can get rid of sentiment. We know what that is. Fear and greed, we can get rid of that. Earnings, Lennar comes out after the close, by the way. And, oops, where are we at? And again, with lumber prices, even though lumber prices are softening and they're improving a little bit, you're still, what, 250% or so higher than what it was a year ago. So it's still absolutely crazy what's going on with what's going on with lumber prices. So I think that when you look at this kind of stuff and you say, okay, what's Lennar going to report? I have a feeling it's not going to be that great. So we'll see. Won't clear severe housing shortage for years, real estate agents say, after housing starts disappoint. So yesterday is when the home stuff came out. U.S. needs about 5.5 to 6.8 million additional housing units, but is currently on track to build only 1.6 million this year. So here's what you have happening. The borders are open. People are flooding across the border. There's no place to keep them. They're keeping kids in cages, etc. And you have a massive housing shortage. And then you have forbearance and rent stuff happening that are going to be expiring at the end of this month on June 30th, unless individual states extend the moratorium on foreclosures and evictions. And even if they don't extend it, you still have 90 to 120 days for those cases to clear the courts before those people are tossed out. Because at this point, even paying them to leave, they have nowhere to go. And you can't, like, people cannot sell their house if they're in forbearance. If they chose forbearance at any time between March 2020 and right now, they cannot sell their house. They can't even list it to sell it. It's against the act. So they have to wait until the emergency or the moratorium is over. Then they can take advantage of it. And the reason why is what the government has said and told mortgagors to do is this is the bailout nobody else talks about. The Fed is doing what Goldman Sachs and Bear Stearns and Merrill and all those guys did back in 2003 through 2008 to 2009. Foreclosures peaked in 2011, 2010. So instead of Bear Stearns and Goldman buying all the mortgages, the Fed has been buying them. Not only that, the Fed has said, we'll buy the mortgages because there's not enough capital in the market because of the COVID. So we'll buy the mortgage-backed securities. But in order for us to do that, anybody in foreclosure, no matter what the circumstances, when they come out of it, you can't raise their payments up and say you want all that money. You have to add all that money onto the back end of the loan. In other words, that 30-year loan is now going to be a 31.5. Really, by December, by the time these things clear, a 32-year loan. 20 years is going to be a 22-year loan. A 15-year loan that went into forbearance last year is going to be a 17-year loan. And so that's what the companies are going to do. The ones that are going to get tossed out, the ones that are going to get foreclosed on, is going to be a lot lower than what I initially thought it was going to be. Up until they pass that portion of the stimulus and everything else, I didn't think, let me turn down the music a little bit here. I thought that we would have a major housing correction. I still think that's going to happen, but I think it's going to be a couple of years out. And probably 2023-ish. So here we go. So housing starts rose 3.6% to a seasonally adjusted annual rate of 1.57 million in May from a downwardly revised print of 1.52 million the prior month. They expected it to increase to 1.63. Yeah, but they didn't count on lumber prices increasing. Even my house, it's for sale right now. I don't have to sell. I want to sell. If it doesn't sell for another year, I'm expecting another 11% increase in prices where I live at over the next year. So with that happening, I don't have to sell. So when these clowns call me and they say, hey, will you sell your house on terms and do a contract for deed? And I tell them they're full of crap in a rising interest rate environment. It's stupid. The scarcity of key inputs was the main cause of the slow housing starts, with home builders constrained by acute shortage of construction materials and labor. I saw an ad on Facebook for pipe workers, for electricians, for concrete workers, $40.70 in Seattle area. 40.7 times 40 hours, $1,628 a week times 52, $84,000 a year starting pay to work concrete. You work hard, yeah, but you're going to make $84,000 doing it. They can't hire people. Why? Because we have an idiot governor, Inslee, in the state of Washington, that has continually extended the federal unemployment benefits to keep people at home, to keep them under control. Now, the thing you're going to be hearing about is we went from COVID lockdowns to, guess what the new one is? You ready? Avoiding a climate lockdown. Now, the WCSD, guess who they're backed by? Anybody? Our partners. I believe they're also backed by the WHO. And it may not be them, but it could be somebody else. Here we go. Examples include city or country level governments, UN organizations, EU, policy partners. Okay. So if you don't think that COVID was a lot about control, it's about control. And instead of having COVID lockdowns, what they're going to be talking about now is this. Climate lockdowns. It's all about control. Get yourself independent. Get yourself financially independent. Get yourself, socially independent. The whole 9 yards, because it's coming. And if you think the reset is crap, the great global reset is crap, reading stuff like this, where they partner with world government agencies and policymakers, shifting Arctic ice, raging wildfires in western U.S. states and elsewhere, methane leaks in the North Sea are all warning signs that we are approaching a tipping point on climate change, when protecting the future of civilization will require dramatic interventions. Now, you tell me if this sounds like communism and socialism. Under a climate lockdown, governments would limit private vehicle use, ban consumption of red meat, and impose extreme energy-saving measures, while fossil fuel companies would have to stop drilling. To avoid such a scenario, we must overhaul our economic structures and do capitalism differently. If you don't go read this article to see how nuts this is going to get, it's coming, folks. It's coming. The disease of the Anthropocene. Moreover, climate change will exacerbate the social and economic problems highlighted by the These include governments' diminishing capacity to address public health crises, the private sector's limited ability to withstand sustained economic disruption, and pervasive social inequality. What the hell does social inequality have to do with climate change? Zero. Nothing. It is a scam. It is a scam. Global warming will cause drinking water to degrade and enable pollution-linked respiratory diseases to thrive. Let's see. What would be a respiratory disease? That thing that happened last year out of that country over there, associated with Hong Kong. That thing was respiratory. 3.5 billion people globally will live in unbearable heat by 2070. Yeah, they said it was going to happen in 95. They said it was going to happen in 2000. Then they said it was going to happen in 2008. Then they said it was going to happen in 2010, 2015, 2020, 2021. I don't give a rip about this crap. You know why? Because in 100 years, we will be so economically developed in terms of solving the battery problem with solar and wind. They're unlimited. Hydropower. When they come out with this ignorant statement about global warming will cause drinking water to degrade, 70% of the entire world is water. The amount of water on Earth has not changed at all. There's no such thing as a water shortage. there is a shortage of water location for acceptable use. You just have to make the technology. The Middle East, they have desalination plants everywhere. Carlsbad, California built their own desalination plant along with a reverse osmosis plant. You don't believe me? Check this out, man. You're so worried about this stuff, build more. Carlsbad desalination plant. It's a whole bunch of reverse osmosis filters taking seawater in and converting it to reverse osmosis. You know what reverse osmosis is? That's the water. That's the Costco water you buy. The Kirkland brand of water is reverse osmosis. You might have a Culligan system. Reverse osmosis goes underneath your sink. All these are RO filters. They make reverse osmosis water in Carlsbad, California. There's no such thing as a water shortage. It's crap. It's not true. All you got to do is make the stuff that people know that will clean it. That's all you got to do. Process it. We've been doing it on United States submarines underneath the Arctic ice, converting seawater to drinking water for decades. We can do it at sea. We can do it for land. And then it's just a matter of distribution. Distribution. If you think there's going to be a water crisis, great. Increase the solar, increase the wind energy, increase the hydropower, and then take those drivers that were doing fossil fuel and employ them to haul water. Or maybe a water pipeline. Oh, there's a novel idea. Take the XL pipeline and say, hey, instead of hauling oil, guess what? You guys are going to haul water now. All right, let's see. Last look at the markets as we look to close here in 4 minutes. Dow down 251. Now we're pulling back again. NASDAQ down 24. S&P down 20. VIX back up to 17.67. 3-minute charts. Bitcoin has been dropping steadily all day, pretty much since midnight. Topped out at midnight and then dropped midnight Pacific time, 3 o'clock Eastern. Has been dropping all day. 24.22 on Ethereum. ADA 1.51 back to where I bought it at, basically. Actually 2 cents lower. I bought ADA last at 1.531. I bought Matic last time I bought it 1.4159, and it's still up 1.53. So 1.4159, 4159 divided. I should have sold it yesterday. I didn't. 5332. So I'm still up 7.65% on my Matic. So that's okay. I'll take that. Any other movers to the upside? Palantir. AMC had a nice run. Bounced off the bottom pretty good here, though. It bottomed out. One of the alerts that went off for me was AMC hitting the bottom. And I put that alert in a while ago. I forget where it was. I put it in all the way back here. And I think it was at this level. I already erased. I think I already deleted it. Yeah, I already deleted it. But I did set another alert level down here on it. So we'll see if it gets there or not. This actually looks pretty good here. You got a nice ascension here, higher highs, higher lows as well. Nice. We can zoom in on that. Sorry. It's slight, but it is ascending. Volume is okay. If you discount what happened this morning, that looks pretty good. So Dow down 264, 2 minutes to go. Coinbase back down 227, buying opportunity. Every time it comes down to these 220s. Let's go to 1 hour chart. Let me remove the external. Sorry about that. Since May, middle of May, it's kind of hit this area. So you can probably 217. We'll set an alert down there, maybe pick up some more. GameStop up 25 cents. All right, S&P 21, less than a minute to go. right at about a minute. Then we're going to end the stream for today. Stuff to do, people to see, money to make. I'll probably do some trading. I want to look at next time this runs up. I'm probably going to take some out, keep some in it just to run it, and then trade some. So we'll come back down to this level, first 4%, and then you can buy it back down here, make another 2%. So we can look at that. All right, there we go. Market is closed. Right about. Ding, 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 ding. All right, market closed. All right, so the Dow ends up down 264 on the day. NASDAQ ends up down 33. S&P ends up down 22. So SPY was down 2.22. And you can go look at the futures and see what they're going to do at 5 o'clock Pacific. All right, so now I'm going to move into my Ethereum and Bitcoin mode. I'll leave this open. I'm going to end the stream, but I'll leave the charts up. And let me put it back over here where I want it. Oops, hold on. There we go. And I will make that big. And do I have anything else over there? I think, nope, I think that's it. All right, so I will, you'll hear me on the thing here in a second here. So right screen on, left screen off, drag back over to here. Okay, and then we're going to go to 24-hour street. All right, so that's going to do it for me. I'm going to leave this going. The buy-sell indicators will leave up for Bitcoin and Ethereum. And let me make those just a little bit better here. That's on auto. 3 o'clock. There we go. There we go. All right, there you go. All right, folks. That's going to do it. Hey, Knight, thanks a lot for tuning in. Have yourself a fantastic night as well. And I'll leave this up, and we'll see you all tomorrow morning for live commentary. Bye.
waking up to my heartbeat, accompanied by the rain. The soreness in my eyes is not very surprising. This room is still uncharted, but as soon as I get started, I'll send you an SOS. I'll wave like it's nobody's business. Give me some time to breathe. Give me some time to speak. Cause I know the truth inside. And I promise you this time, no bravado, no more strange, stupid games, just one motto. No more pain, all in vain. Let your guard down. Call my name when you need a friend. No bravado, no bravado. Standing out in the crossroads, trying to make out where to go. You left without warning, and now you're ignoring me. So what about us? What about all we had? Just send me an SOS. I'll run to you faster than lightning. Give me some time to breathe. Give me some time to speak. Cause I know the truth inside. And I promise you this time, no bravado, no more strange, stupid games, just one motto. No more pain, all in vain. Let your guard down. Call my name when you need a friend. No bravado, no bravado. No more strange, stupid games, just one motto. No more pain, all in vain. Let your guard down. Call my name when you need a friend. No bravado, no bravado. I've been acting like a wild man, sleeping like a giant. You're so luminous and vibrant. I'm always in bloom for you. Always in bloom. Always in bloom for so many times I've stranded, a castaway on unknown shore. Although stranger in this continent, I'm always in bloom for you. Always in bloom. Always in bloom for an infatuated light. 받고 해가 뜨고 눈을 감아 엉켜버린 사이코 같은 패턴에 눈이 돌아 몇 년 동안 사이코 네가 잠이 들 땐 너와 함께 하고 싶어 미쳐버린 내가 과연 너를 이해되나 싶어 밤만 되면 이러는 게 병인 나로 싶어 하지만 다시 밤이 찾아오면 나 I got that fire I got that juice 밤이 되고 난 vampire 괜찮은 물 I'm building on my empire with that loop feeling like I'm Alexander 다 빛이 내리쬐며 밤이 돼 난 vampire 밤이 되면 난 vampire okay 내리쬐지 베토벤의 월화 I sipping juice from that moonlight 지저나 쓰러져 Monday는 전반대 밤이 되면 동공은 확대되지 Monday through everyday 창조 중 그 후에는 박대 머리가 잠들 때 너는 더운 맑아지는 느낌 변한 끝에 살아도 평생 나는 지신 묶인 말하며 그저 내 삶이라 되는지 잡아봐 내가 어디까지 가는지 그걸 내 거리는 하고도 과연 내가 빛을 내지 못하는지 악마를 내가 가라앉기를 원하지 불꽃이 꺼지길 원해요 But 언제나 빛이 나니 정답이 뻔했지 정답이 I got that fire I got that juice 밤이 되고 난 vampire 괜찮은 물 I'm building on my empire with that loop feeling like I'm Alexander 다 빛이 내리쬐며 밤이 돼 난 vampire 밤이 되면 난 vampire okay 내리쬐지 베토벤의 월화 I sipping juice from that moonlight 지저나 쓰러져 I got that fire I got that juice 밤이 되고 난 vampire 괜찮은 물 I'm building on my empire with that loop feeling like I'm Alexander 다 빛이 내리쬐며 밤이 돼 난 vampire 밤이 되면 난 vampire 내리쬐지 베토벤의 월화 I sipping juice from that moonlight 지저나 쓰러져
Caught behind Venetian blinds, out of reach for the city lights. This ain't where I belong. Hey, look at me, man, what I've become. I've been running east, looking for a sunset, digging deep since '99. What I thought was gone was sitting in my pocket in plain sight all along. I think it's time for me to go, burn all bridges. All I know, I got lost along the way, fell between the foam, pulling stitches. Time to let go, so come what may. Don't look before you leave. What you give, you get to keep. So long, farewell, bye-bye. Let's have a toast for those lost